Good evening, welcome to the Business of Property. I'm your host, Cheryl Leong for Property Development Australia. I begin today by acknowledging the traditional custodians of the land on which we meet today and pay my respects to elders past and present. I extend that respect to Aboriginal and Torres Strait Islander people here today. So at the Business of Property, we interview superstar guests in the property development space that share their expertise, their deals, and stories to help empower, build, and grow our community of property developers. So hello there, Facebook land, LinkedIn, and YouTube. Give me a shout out if you are here with us today. And so we're actually going to be speaking to David Ingram, co-founder and CEO of 𝐶𝐚𝐬 Property, and also Daniel, who are part of this really interesting marketplace lending platform that brings together small and medium residential property development. So we've got development and we've got finance here, and these guys have been able to bring this platform to Australia that does it in a really ingenious sort of way, which allows sort of peer-to-peer lending. So people wanting to invest in developments to people who are looking to get finance for developments. So without sort of further ado, I'd love to invite the both of them down onto the Property Development Australia dance floor. Welcome to the Business of Property, gentlemen.
Hello.
Hello. Ian's here, excited to see you all. Good to see a rose between thorns. At the moment, the rose looks like David. So thank you. In the screen. So David, tell us a little bit about, I guess, your background. You are obviously no stranger to the prop tech space. Tell us a little bit about your background and I guess how this concept of 𝐶𝐚𝐬 Property has come about.
Yeah, thanks, Cheryl. You're right. My previous business was actually called Split It. You're right, it was in the prop tech space, and we brought a slightly more transparent business model to actually at the time utilities connections and then on to financial products like mortgages. So ultimately that business went on to be part of the Loan Market Group, where I started working there with the brokers and started to understand, I guess, some of the real pain points for small property developers. I guess up until that point in my journey, we were all about comparison and about transparency, and finance was much for muchness. It was a product, it was a commodity. And when we've probably all looked at our home loans and compared them, and we've been looking at the lowest rates. I guess when I started talking to property developers, I started to understand there's a whole world of pain out there when just trying to deal with the banks. So that's where this kind of search for, I guess, an alternative funding solution came from.
Yeah, and what were those pain points that you've identified? Because I know you did a massive survey across Australia to try to understand, what the experience is, and what sort of has come out of that.
Yeah, I think some of these things will be very familiar to the audience this evening. In fact, have we got the slides? Can you see those? Because we might be able to just show you a few results of those surveys.
Put this together. I love for those of you that are joining us here today. What are the pain points that you're experiencing or have experienced dealing with, whether it's the banks or any other lenders? What are the pain points that you've experienced in your financing journey so far? I'd love to hear.
Yeah, as I said, I think some of these things will really resonate with the audience. Can you see the quotes we've got up on the screen there, Cheryl?
Yeah, I do.
Yeah,
no,
so
I think the next slide.
Okay. Have you got that now?
I still see property finance by property people.
Okay. How do we progress this along? Slight technology. Anyway, I can talk to it while we figure out the technology. So, actually, as part of we went into the first lockdown, we were talking to developers online, and some of these are the quotes which came out of it. Things like banks might look cheap money, but it's actually a higher price you pay in the end. That one really resonated with me. I really remember that. Nobody understood property. As part of the journey, there were many surprises along the way. There were cheap money from the banks, but you really had to do the dance to get there. So I think the key point for me was really that nobody understood property. So there's certain things which bank lending makes a lot of sense for. But if your project kind of falls outside of that category, you're really left a little bit stranded.
Yeah. And Daniel, being obviously part of the Crowd Property team now, but an active developer as well, which of these statements resonated predominantly with you?
Oh, look, all of them, and I think speaking to our fellow developers, and it's not uncommon to be 3 to 6 months before you receive any money from the banks, but at the same time, it's not being able to talk to the right people that you want to, being able to being put through like 5 different sections of a bank only to get an answering machine, and that's just the 10th phone call, right? So these are just some of the examples, and part of my joining Crowd Property was actually through my own pains of banging my head against the wall, figuratively speaking, and realizing that there has got to be a better solution out there. And so here I am on the other side, hopefully helping developers to get better finance.
Absolutely. So tell me what, and I'm sure the audience would like to understand, where does Crowd Property sit in this landscape now, where we've got sort of your first tier lenders, you've got second tier lenders, and then you've got private funding. Also, you've got brokers, commercial brokers that are brokering different lenders. Where does Crowd Property sit in all of this?
Yeah, I'd say we're actually an alternative to all of those channels. We primarily, I think, importantly, we want to deal with developers directly. So the broker channel is not necessarily, it's one we could potentially use, but it's very important for us to actually talk to a developer, not only understand that their project stacks up, but understand what are their motivations for doing the project, and kind of really help them along that journey. And I guess the concept is about property people. So that piece about going to a financier and trying to find someone who understands your project, that's where we want to be, and we want to add value. So yes, we do the same due diligence. We perhaps do more due diligence than perhaps the banks do, but it's on the project. And part of that, we're adding value in that process. So on the other side of it, we're providing project opportunities to investors. So here you can come onto the platform, you can look at projects, you can decide, you'd like to meet that developer via a webinar online, you can see all the details about their project, you can select a project to invest in and back, and you'll get a target 7% interest rate return, all first mortgage secured, and a short-term loan of around averages about 15 months on the platform. So it really is, I guess, the platform brings together both the investor side and the borrower side. The platform is interesting from a technology point of view, but at its core, as I say, it's all about that property people lending to property people.
Yeah, I like to just highlight that bit about investors just briefly, because it's not something that traditionally, I'd say, the everyday mum and dad investor has access to. So I'm familiar with private lending, but typically, say if you need to borrow, 2, 3, 5, 10 million, most lenders like to work with one, high net worth, ultra high net worth investors. So what is this allowing investors? What sort of investors are accessing these opportunities?
Yeah, so at the moment, the platform in Australia is open to wholesale investors. Ultimately, it will be opened up to all investors, so as retail investors, as they're called. The minimum investment is only $10,000, which again is very different to, I think, the ones you're referring to, Cheryl, which often have much higher thresholds for you to invest in deals. So this allows you to come onto the platform and perhaps invest across, could be a self-managed super fund, for example, or you could invest for a company or as an individual, and you can diversify your investment across a number of different projects.
Yeah, absolutely. So I mean, let's dive a little bit further as to, I guess, further into the type of problem that you're solving and how you're solving that for developers, particularly developers in that small scale, who are in that small scale sort of level in the development game.
Yeah, it's all right. So yeah, I think the point of difference where we kind of play, just going back to that research piece, if I can, just quickly, we obviously ask developers what they thought about their existing financiers, but when we broke that down, the most important things people wanted from, and this is the problem I think we're solving, which is around transparency, about speed and access to finance, how easy it is to do that. Really importantly is those access to those decision makers. When we break that down a little bit further, if we look at the less experienced developers, they're typically coming to us trying to, make that spreadsheet stack up. So that's about how much can I borrow, what's the interest rate going to be, what fees do you charge? And for those people who've been through the journey before, it really comes down to, actually, it's more about the non-financial issues with finance, which is kind of interesting for us. So how do I get ease and certainty of capital? And you can see that on this chart here. You can see that red line there. The interest rates for those experienced developers is not actually the most important thing.
That's what I've noticed. I might just get you guys to move your slide a bit so we can have a look at the lines that you're talking about, because that's the thing that stood out for me. That we often think it's interest rate, but from your particular graph here, so this one's for experienced developers, and it shows like interest rate is way down.
Yes, if you look at the diversity, so the top line, that faint green line on there, is actually those less experienced. They've done maybe 1 or 2 projects behind them, and they're placing a lot of importance on what's your rate. Whereas the experienced guys, you can see, where that red line peaks there, it's actually access to decision makers, it's speed, it's transparency. These are the things which I guess people who have lived and breathed it, have been through, have experienced before. So this just helps you when you're next talking to financiers about what's actually important and some of the questions you should be asking.
What do you mean by transparency?
Well, if we actually roll on this, there's a very, very good point. Here's an example on transparency. How many people actually know what the penalty rates are? So if we all know projects overrun, right? So what happens at the end of the day? Very few people could even actually answer that question. What's even more disturbing, actually, when we look at, I guess, some of the other lenders out in the market, is around, I guess, some of the hidden fees which you don't see. So, for example, we've seen projects which are quoted on quarterly interest. So that means if your project overruns by just a day, you finish up paying a whole nother quarter of interest. There's penalty fees on top of penalty rates. Margins are added on top of professional fees. So these are all the kind of pain points we see, which come out of that lack of transparency.
And these are, you highlight these, and like you said, often people probably, unless they've got their solicitor going through their lending agreement and documents with a fine-tooth comb and explaining to them what it means, it might actually just get lost in all the legal stuff, because often, loan documents can be about that thick. And I've sat down with our solicitor before, and he's gone through almost every single clause to pick these things up. But the scary thing, like you said, if it gets just lost in the loan documents, where does that leave people in terms of, I'm going to pay off the loan early, we're going to slap you on these fees.
Yeah, absolutely. I mean, we've just had a case, I think, this week where someone was actually looking to do that. They were looking to refinance, and they came to us looking for, better rates, but also, service ad, which is going to allow them to go to the next project and the next project after that. But when they actually looked at, the fine print, it was not going to stack up in terms of the penalty rates, which we're going to hit with. So we have a very different model. We're very transparent. We only charge one success fee once we successfully raise funds for the project, and that's just on the drawdown. So we don't charge you up front for the whole of the loan. It's just for that initial cash flow drawdown. And then there are no other fees in there. So, for example, if you want to, if your project runs to time or even early, there's no early penalty fees, for example.
Cameron's joined us today, and he says interest rate is of little use. You waste time chasing it and you don't end up getting funded because the funder just didn't get it. Yeah, absolutely. And so how is Crowd Property providing a solution to this? And I'm really keen to understand, again, I'm sure the audience is, how this compares to what's available at the moment.
Yep.
So the solution is remarkably simple, actually. If you go on to the next slide there, we've got an illustration of just how complex people try and make property. As we all know, there's plenty of people in there trying to clip the ticket. There's profit pools, there's inefficiencies. So what our platform allows you to do, as we said before, build that direct relationship with both the investor and the developer. So that allows us, from an investor point of view, to pass those efficiencies back on into better returns than you might get otherwise. And for a developer, as I was saying before, it allows us to kind of add that value without you having to potentially pay to go for a broker, for example. So yeah, it's a very simple, it's a transparent model which we offer. We know speed is important, as we've shown from the research. So being able to come back to you with a term sheet within just a few days of contacting us, and that term sheet won't change. So it's not like you'll go through the whole process and then suddenly we'll turn around and say, we forgot about this, there's a fee for that, or now you potentially have to service that loan. So not only is it offers speed, that offers certainty, so you know what you're working with from there. From there on, we go into a due diligence process. But it's once we get to the point where we're happy to go, we do an independent valuation and a project goes up on the platform. Typically, once the loan is settled, our developers are paying from around 8% per annum, and for a loan period is somewhere between 16 to 18 months. Average on the platform's about 15 months at the moment. As I mentioned before, there's only one fee, only on the funds drawn down, so that means no line fees, no early repayment fees. We offer first mortgage and probably better LVRs than potentially some of the other lenders or traditional lenders, so up to 70% based on GRV. And for the right project, we can also look at potentially stretching that with a second mortgage capability as well.
Yeah, and David, I did want to find out, do you just have one interest rate, or is that sort of in relation to the risk, the risk appetite for that particular project? Yeah,
absolutely, Cheryl. It's like any project, it's based on risk and complexity. So there'll be a range from probably around that 8 up to 10% mark.
Yeah. But the good thing, like you're saying, is that it's the interest rate and then there's a success fee and that's it. There's no other.
Yeah, and sometimes people will look at that and go, particularly if they're coming from, traditional banking loans of, 3-4% being charged, that looks high. And Daniel can explain a little bit about what the difference is going to commercial finance and how we can actually help you grow your business, because you can access those funds faster. Will enable you to go into more projects, into bigger projects, which actually it stacks up in the end for everyone involved.
Yeah. So I think, let's have a look at that, because one of the things that I know when we spoke about before was, how does this compare to the banks, the brokers, and where does Crowd Property sit here And at the end of the day, developers want to have a level of certainty. That's the main thing. Whether I'm going to get funded, what those rates are, and to get a real quick response on that.
Absolutely. So we've put together a bit of a comparison table so everyone can see that hopefully clearly there. So there's a range of points, but start from the top and make our way through. One of the first things that we're concerned about as developers is actually speed. When can I actually get funded so I can actually go and build the thing, right? So so with us, we're looking at anywhere between sort of 3 to 6 weeks, whereas with a traditional lender, you're looking at anywhere between 3 to 6 months from application to when you get your money. Now that's quite a significant difference. That's potentially 1.5 to many months, and you're just you're literally just banging your head against the wall during that period. We all have funding available. We've all got funds. Whether it's crowd property, broker, banks, there's all funding available. Property expertise, that's a big one. Are you actually talking to somebody who understands what you're trying to achieve here? Now, I just want to be clear, at Crowd Property, we don't finance motor vehicles, we don't finance equipment, plant and equipment. We finance property developers, and that's all we do. Day in, day out, our team has development experience, and we do our own developments as well. So we're happy to use that expertise to talk about the deals that you've got running. We spoke about transparency earlier on. Access to the decision maker. I think that's an important one. When we sign off on our emails, whether you're talking to myself or another member of the borrower team, we've all got our phone numbers, so you can actually call us. And I'm happy to admit I don't have a separate Crowd Property phone. When you come through, you get me directly. So we're happy to have a conversation directly with you. Higher LVRs potentially, and we can go through some examples later of how we can allow you to make best use of the equity that you have. Essentially, putting your own money in to make best use of that equity in one deal or multiple deals. We spoke about having a second mortgage available where we can increase those LVRs even further, again, allowing you to lever up to do bigger and more deals. And we assess individual deals on merit. So what that means is we look at one deal that you have on its own merit, irrespective of what your income is, irrespective of how many investment properties you hold, irrespective of what other deals you've got running. We only look at that deal on its own merit. So we can lend based on just that deal.
And just on that, Daniel, because we are looking at sort of the smaller scale developments and developers, how do you look at developers who are just doing their first or their second deal, their first 3 deals? How do they get assessed?
Yeah, I mean, we look at people doing their first and second deals, and we say, look, if you don't need to have done 6 or 10 deals to get funding. If you've done one that's of a similar size, great. If you haven't done one, we look at you and say, look, are you getting any mentoring from a group? Are you being guided by people who have done this before? And we look at that quite favorably, actually. And we know that those people who have done it before are happy to contribute, and we can look at it from that perspective.
Okay, great. So say if someone's got a project manager in the project, being able to sort of leverage off that experience as well, or being an experienced developer as well, you can sort of have a look at the numbers to see if they actually do stack up.
That's actually a really good point, Cheryl. It's really interesting. We've got an example of this later on where somebody may be a project manager or a development manager for a very large developer doing hundreds of millions of dollars of deals, yet they can't get funded on their very first small scale development. So they're the things that we look at and go, yep, you've got far more experience than a lot of people. So we're happy to fund and take experience from other areas as well.
Yeah, I think that's a really critical point, particularly with the private funding, that I have found just speaking to different developers that they're like, this is my first deal, but the private funder won't fund me because it's my first deal. And understand, that's their risk appetite. But I think the fact that you're saying, hey, we will look at it and we will assess whether it actually stacks up, because you're doing some level of due diligence yourself as well.
Yeah, and I think that's the difference, again, being able to talk to decision makers who've walked in your shoes before, right? So they understand where you're coming from, and it's the ability to then look at the whole team. So we don't automatically reject it. We have a credit policy, which does mean that we can look at developers early in their stage of the career, but then we have to look at some other things. So we look at who's, as Daniel says, who's in the team around them in particular is very important. Are they getting coaching? How much skin have they got in the game, etc. So that's just a difference in approach to, I guess, falling outside of that and instantly getting a computer says no type of response.
Yeah, absolutely. Computer says Daniel says no. Well, I want to share my own experience, because one of the things, and we'll come to the next part, is that it's not just development finance. You've got a whole range of different, for want of a better word, products, I guess, or different types of development or stages of development that you can fund. And I'd like you to sort of just briefly walk through this, because one of the reasons why we connected was I not only was attracted to the fact that you've got this crowd, peer-to-peer funding model where you're giving people investors access to the ability to fund development deals, but also fund these co-living projects we have. So it's about giving more people access to what was I going to say? Affordable rentals, and then more people access to different ways to grow their wealth as well. So I'd love for you to talk us through what are the types of products and developments you can fund which are outside the norm, I guess.
Yeah, so the first thing is obviously development finance. So if you're buying to settle the land and you're looking to develop and build, we obviously do that. That's our bread and butter. That's our at the core of what we do. But beyond that, we've got situations where it's a bit more complex, and this is where we play to our strengths in terms of helping you as a developer to get your finance through. So one of those things is if you're doing a joint venture partnership with the landowner, or if you're doing a JV with somebody who's putting money into the deal, or a combination of those. We're very happy to look at those deals. It's nothing is too complex for us from that perspective. We also look at things like boarding house, co-living, HMOs as well. So if you're doing something of that scenario, we're happy to look at those deals. Happy to look at residual stock finance, although there's not a lot of residual stock sticking around in the market these days. But an example of that might be if you're doing a 4-townhouse development and you've sold 2, but you found the deal of the century and you want to get into the next deal, we can potentially look at financing you out, so you're not having to take the next lowball sale just to get into the next deal. You can actually hold out for the pricing that you want, and that's the sort of flexibility that's built in to allow you to do more deals. Modular finance is another one. So modular builds or building methods that are slightly out of the box and something that's a little bit different. We're happy to look at those. In the traditional methods of building that we obviously finance, but there are modular builds that we're talking 3 weeks rather than 6 months before you get the shell complete built and locked up. So happy to look at that.
Really keen to talk a little bit further about that, Daniel, because I've looked into modular and prefab build before, and a lot of funders wouldn't look at it because they'd be like, well, actually essentially almost have to have funds straight up, or a bulk of at least 50% deposit down, because it didn't fit into the normal drawdown schedule that finances have. So I think this this on its own is a really, really unique lending product there.
Yeah, and I think modular bills have been around for quite a while now. But if you've looked at it maybe 5, 6, 7 years ago, it might be worthwhile just looking at it again, because the technology's improved, costs have come down dramatically, and so the combination of those two factors actually can make a lot of those deals stack up from a developer perspective. So and the other ones would be airspace as well. So if you're sitting on a property that has air rights above, that may be worth something to you or to a developer.
Yes.
Things
And we spoke to Warren from 𝐵airspace a few months ago. So that's exactly the thing that you're funding, which again is very unique, because I don't know a lot of funders that understand that.
And things like NDIS as well, which is again quite specialized, but we see that as being quite underfunded actually. There's a lot of the barriers that are stopping more of these from going up is the funding, because we know at the back end the yields are very, very good, very good. It's just about getting the finance to fund them and build them as well. So.
Yeah, absolutely. We've got a question from 𝐶𝐵𝑜DE who's asked, what sort of paperwork do you need to see?
Yeah, good question, 𝐶𝐵𝑜DE. Look, I would just say, look, it takes less than 5 minutes to enter some details onto our website to apply to start the conversation. But in terms of paperwork, that's a good question. Ideally, an IM would be very nice, an information memorandum that contains, basic information like why you got into the deal, what you see in this deal, what are some of the numbers, tell us about the location, tell us about what you're building, tell us about how you've thought about the end product that you're trying to build and who you've targeted that to, and tell us about maybe the consultants that you've got on board, who the builder may be. So if you've got an IM, that'd be ideal, but if not, we're also happy to look at sort of more piecemeal information as well, 𝐶𝐵𝑜DE.
Yeah, I think we could probably run another session with you, Cheryl, actually on information and how to provide it, actually, because we do see a very varied quality of submissions which come through to us. But I guess that's also a slightly different model, because we know that's the way it works. There's no penalties for coming and having a conversation. So Daniel's right, you can pick up the phone, and people like this have you almost used it like a bit of a badge of honor in the past of actually getting funded through the project, because not all projects get up onto the platform, right? We've got a strict due diligence process which we need to have to protect our investors and their investments. But there's nothing to stop you coming and getting a second opinion on your project. So getting an opinion from a lender and going, does this project stack up? It's actually quite valuable, particularly if you're at the early stages of working out whether it's something you want to go forward with or not. And we, unlike other lenders, there's no black marks we put against you. So we might have seen 2 or 3 projects from the same borrower potentially before we go, yes, actually this is the one you want to fund because this one makes sense.
Okay.
Each time you've been through that process, you've probably learned a bit on that journey. So
yeah, sort of not unlike sort of residential lending, where you might put an application with one of the big 4 banks and they've turned you down. You sort of get a credit. It almost shows up in your credit file. We've got a few more questions coming through. 𝐶𝐵𝑜DE's asked if you consider an asset management type of funding. I'm not quite familiar with what that means. Maybe you guys do.
Asset management, as in, 𝐶𝐵𝑜DE, do you mean looking at your assets versus income? Is that what you're referring to? If that's what you're asking, 𝐶𝐵𝑜DE, that's it. We look at the deal on its own merits. We don't look at construction and hold.
Build to hold. Yeah, I'd say it's sort of similar to the co-living boarding house space, I guess, in NDIS.
Yeah, so probably the simple answer to that is we'll do the construction part of that, and then you'd look to refinance, because obviously this is commercial lending, so it would be at higher rates for that period, and then you'd look at perhaps refinancing that out with a commercial type product. Reason for that is simply, again, it's transparency. On the other side of it, we've got investors who want to come in and back these projects, but they want to back them for a finite period of time. So typically, as I said, the typical loan period is sort of 15 months, and then our investors can get their principal and interest returned and then go on to the next project. So,
we've got someone who's asked, do you fund at multiple stages of a development? Example, client has funding to lock up stage and needs to fund to complete.
Needs to fund to complete. Okay, so we take a first mortgage on lens. So we typically need to have a look at refinancing out the previous lender on a deal, if that's what you're looking to do. But perhaps we can talk about specifics of a deal. If you've got that in mind, feel free to get in touch, and we can have a chat around that, because every situation is different. Be keen to see why you're needing that funding and where you are with your project. So happy to discuss.
Cool. Well, I think it would be a good time to sort of dive into some case studies, some examples. And what are we doing here, Daniel? We're doing a comparison between crowd property funding and traditional bank funding.
Yeah, it's exactly right. So what we're looking to highlight is, as a small scale developer, how do you, through commercial finance, get into more deals, and how do you get into bigger deals with the ultimate aim of making more profit at the back end and building more of the product for people to move into, or for investors to purchase, essentially. So we'll get straight into it. So we'll use a hypothetical James here. He has a full-time job. He's relatively new to property development. And this here is a 1 into 2 townhouse development, his second development that he's done. He's close to his borrowing capacity, and he's looking to transition to do development full-time eventually, and wants to do potentially 2 to 3 projects in a year, and aiming to limit the amount of equity required for projects. Okay, so we're going to get into some numbers here, but the key things to run through are just some basic economics. So we're purchasing the land at $1 million. We're constructing at 1.1. We've got total costs with things like interest, compliance, consultants fees. We're looking at about 2.3 million in total costs, and we've got a development profit of just over 500,000, and we've got a relatively healthy margin here at 22.6% profit on costs. Now, this is done with traditional bank lending, when the interest rate is a little bit lower. You're looking at 3% for the period of the development for 15 months. And you're putting in 30% of the costs in as equity. So what that means is the amount of money that the developer is putting into the deal, sitting at 700,000, and we've got a return on that equity of 75%, namely the profit of 500,000. So this is your traditional bank lending. So what about with us, or with commercial lending, right?
Sorry, Daniel, sorry to interrupt there. The thing as well, I guess, with traditional lending is typically they may have the requirement that that you need pre-sales. Probably not a 1 into 2, well, probably a 1 into 2.
Yeah, exactly. Bank lenders will have what's called debt coverage. So they will say, look, how much of your development do you need to sell that covers the amount of debt? And it could range anywhere between 50% to, I've seen 100% debt coverage. They want you to completely de-risk it for them.
I've heard brokers talk about like 110 and 120%, which sounds like airline seats to me. But
yes.
So what it does is it stops you from getting on with the project, right? We talk about this momentum when we're building and when we're developing, and if you're requiring 120% of coverage of debt, like that's just you could be getting into other projects or finishing up your project, really.
Yeah, particularly when, I mean, in the current climate where a lot of people are developing sort of owner-occupier stock, and a lot of the owner-occupiers want to see the completed product and want to do the whole touch and feely thing. I'm not finding as many people doing as many off-the-plan sales as they used to.
Absolutely, and especially with owner-occupiers. I mean, why do we do developments, right? Somebody eventually moves into that house, and particularly with families, and we see, young families move into our developments, and we really want to build a great product and want to complete it as quick as we can so they can move in. So every month helps with that, that's for sure.
Yeah, we've also seen deals which have fallen over really in terms of they've not stacked up in terms of that profit on cost bit because they've locked in pre-sales too early. It's really hampered the deal. So yeah,
that's so true.
Excellent. Sorry, I interrupted. Please go ahead.
Not at all. So with commercial funding, it's exactly the same deal. You're still buying the land for $1 million. You're still building for 1.1. You're still selling the end product at about 1.6 million. I've put in a slightly high interest rate here at 8%. And naturally, with a higher interest rate here, your profit goes down. So previously, where were we? Just over 500. We're just under $400,000 of profit. So you think, why do I actually want to get commercial funding? Well, here's the thing. The equity required here is actually significantly less. And it comes from two things. One is the higher LVR that we can give potentially to a developer. So what that means is we can lend more for the exact same deal. And the second part of it is we're able to recognize potential uplift in say a DA for a project. Say you're purchasing this block of land for $1 million, you get a DA on it, and overnight with the DA on it, because we've de-risked the project, it's recognised at say 1.1, 1.15, for example. So a combination of those things allows you to put less equity in. And what we're also not highlighting here is that it's not relying on your serviceability. So you can do 2 or 3 of these deals at once. So I've done a bit of a comparison here with funding with traditional lenders. On the one side, you're acquiring about $700,000 worth of equity. You've got profit of over 500 and your return on equity at 75%. Whereas with funding with the likes of commercial lenders like us, we can look at roughly around the same amount of equity, around that $700,000 mark. But because you're doing 2 projects, your profit has soared over 40% to $751,000. And of course, your money is working harder for you. That return on almost the same amount of equity is working at 101% as opposed to that 75%.
So, Daniel, say for example, someone needs funding for the first mortgage and then a top up with the second mortgage. What are the rates on that? On average, what would someone be expecting for a second mortgage for the extra 10 or 15%? Would you go that high?
Yeah, look, it does vary with the deal and at what stage that funding is required. So if it's all required upfront, obviously it's a higher risk perspective from the investor's perspective. But if it's done throughout the process, then obviously it's less risky, and therefore the rates could be a little bit lower. Look, I would say, generally it would be double digits, and I would say that's commensurate with the risk that's taken there.
I mean, certainly there's, again, coming back to transparency, we've got investors on the other side of the platform. They'll be looking for those higher returns because they've got to be the sophisticated investors to understand there is real risks potentially in, even if for the best projects for the market downturn with second mortgage, it's not for everyone. But I would say on the other side of it, being able to deal with one lender, if you're looking for a first and second mortgage, there's real pluses to that because you've only got one set of legals, you've only got one valuation required. You're talking to one stakeholder as opposed to trying to herd more finances. So there are pluses to that too.
Yeah, fabulous. We've got another question here from the audience. Do you have the appetite for lending to subdivision projects?
Yeah, absolutely. We've funded one very recently, actually, which is down South Australia way. So yeah, we absolutely do anywhere from 1 into 2. It could be 1 into 30. It could be larger if it's broken into different stages as well. We may look at, not considering a 2,000 lot subdivision or anything like that, but yeah, look, we're absolutely happy to look at subdivisions.
Yeah, great. And Sabro's asked another question: how do you handle investor engagement?
Investor engagement, well, the platform's great because it provides the ability for you to log in and as I was saying before, decide which project you want to invest in. By all this information is up and available on the website. We run a webinar with our developers, so you can meet them and their team, and then we do regular updates. So as the project progresses, all our investors get an update, so there's no surprises with projects. You can see how they're tracking at each stage of the project. So yeah, plenty of information there.
Awesome. Well, let's head into the next case study. There we've got townhouse development, and let's see how this sort of compares.
Yeah, so we've spoken about, up to this point, about scaling up in terms of the number of projects. We've gone from 1 project to 2 to potentially 3. So what about scaling up in terms of the size of projects? What about instead of a 2 townhouse development, we're looking at a 6 townhouse development. So hypothetical Tim here is a builder developer who's done 3 of his own projects, and potentially managed many more as well. He's got extensive PM knowledge and experience. He's looking to do bigger projects, and he's looking to maximize profit. He's looking really to make his money work harder for him as well. He's perfectly capable of doing these larger projects. He's looking for funding to do that project. So again, apologize in advance for the numbers layout there, but just going through again some basic economics. Land acquisition is buying the land for 1.2 million. Construction cost is quite a bit higher because he's building 6, not just 2 now. You've got more consultant fees, more compliance because there's more of them. Your in sales values, you're looking at about just under 6 million for this particular example. Your total costs come to over 4 million. Your profit at 900,000. Again, a healthy margin of 21.9%. Now, again, that's funded. If that's done through us, we can look at equity amount of roughly, say, 17%. And again, we're wanting his money to work harder, so the return on equity is 129% there as well. So let's just do a quick comparison as we've done previously on funding the 1 larger deal versus funding the 2 smaller deals. So this example versus the last example of the 2 townhouse development. So interestingly, the equity required is actually very, very similar. Whether you're doing the 1 larger deal or the 2 smaller deals, your equity is around 700,000 or just over. But because you're doing a larger project, your return on equity, and because you're putting in less equity because of the higher LVRs that we spoke about, you can essentially lever up more, and you can essentially make a higher profit compared to if you're running 2 smaller projects. Now, the other thing is there's argument, Cheryl, that if you're doing 1 project versus 2, that it's also less work as well. I would argue that's a maybe, because maybe 2 smaller projects are less work than 1 larger project. But that aside, at the end of the day, you're pocketing more profit compared to if you're doing 2 smaller deals. Hope that makes sense.
Yeah.
And then we've got the last example here of co-living. So I just wanted to put that one in there as it's something that we're happy to look at and happy to look at funding. And so we'll use the hypothetical developer here of Sarah, who's completed 6 projects over the last 5 years. So she's done a fair few. But the banks don't get it. The banks don't get co-living. They don't understand why you're renting them out by room versus the whole development. They just don't want to deal with it. They don't understand the requirements. They don't understand how people run it. Again, we're happy to look at that. We're happy to look at recognizing valuations where they are due. And you know, for example, this one here, land acquisition at 700, cost to construct at 900, gross sales at 2.5 million. If that was done just as a simple duplex, we're probably looking at about a 1.7 million dollar gross sales. But because of the income that's generated, it uses more of a cap rate. So in this case, what have we got? A gross 8% return, returning 204,000. Now you've got to take some costs out of that, but gee, that's not a bad number, is it? If you just hold on to it, and you can see here, if you sold it, you make a profit of 362,000, or you can hold on to it and just get really, really good cash flow, and which is why. As you'll appreciate, Cheryl, why most people hold on to these things and don't like to sell them.
Yeah, absolutely. And again, we're going through this process, and we're developing co-living. We found it quite difficult to find funders who understood what we were looking to achieve, but it made sense. So the thing to point out for this sort of developments is that you do need to have an exit strategy in terms of refinancing out of the construction loan.
Yeah, correct. We're happy to help with the settlement when you purchase. We're happy to help with the construction part of it. But ultimately, you would want an exit in mind, because if you're holding it for whatever it may be, 5, 10, 20 years, another lender can come in and become that financier for that part of the journey.
Awesome. Cameron's got another question. Would you fund, say, a 1 into 3 or 4 that is to lock up, but the project needs to be completed? Seen of these piping up whereby small developers have gone bad 3/4 through the deal. I'm assuming that's a refinance. That's a refinance play there, but over to you.
Developers and builders, right? I mean, we're hearing in the news there's a few builders who are in a bit of strife at the moment. Look, it's not something that we say, well, look, we will fund any day that we can tick a box. It is something we're happy to have a discussion about. So if that's happened on a scenario where developers gone bust or the builder's gone bust, look, we're happy to have a chat if that helps, and see how we can come in to assist with that situation. Because ultimately, both for the developer and the builder, nothing happens when it just sits there. The end buyers aren't happy because they can't move in. The builder's not getting paid, and the developer can't exit the deal. Right? It doesn't help anybody, and we don't like to see that happen to anyone. So we're happy to assist where we can, and certainly have a look at the deal for sure.
Yeah, I think there's a good point about the builder and how important they are. So part of our due diligence process, we look quite carefully at who the builder are, including right into their financials, and including them on the documentation as well. So sometimes that comes a bit challenging, but it is very important. And the recent news is bearing that out. I think that kind of project, if you're looking at stepping into it, you've got to realize the costs involved of any builder coming in and picking up that project is they don't know what risk they're taking on, and therefore that's going to be reflected, I'm sure, in any quote you're looking at bringing into that. So it's quite likely you're going to see those costs go up. We'll look at any project on a project by project basis. So if there's one in particular, send it through.
Cool, thank you. So who can crowd property help?
Oh, I think we've probably touched upon it already, right? So we're looking for those people who are they might have done a project or 2 or 3 or however many before, but they're really reaching that serviceability point where they're thinking about commercial lending. So if you want to look at funding bigger deals, funding more deals, if, as I say, you're hitting that serviceability threshold and the banks are starting to say no for whatever reason, And that could be just purely because they don't understand your deal, as we've kind of touched upon already. And then, as we've seen from the research, right, people are coming back time and time again to crowd property because of that relationship they built, and it's a trusted relationship with a decision maker. If you go to the website and read any of the testimonials, you'll see crowd property being described as almost having like an extra member of your development team, having them on board, because we want to see your project success, and that's right from the start, right through to the finish. So being able to tap into that expertise, it's a very different conversation to I've had in a former life with traditional financiers lending, when it's just all about the term sheet, really.
Yeah, and I think one of the things as well, and I used to hear this quite a bit, where particularly with private funding, that the lenders were really looked at like sharks, where it was they were just waiting for the project to go bust, and then they come in and basically take over, which is obviously not what we're looking to achieve here, by not having all those sort of special and fees and interest rates that sort of are hiding in the loan agreement. So that's a really important point to note as well.
It comes back to, if we make a project success, it's successful for the developer, it's successful for the investors, it's successful for the platform. Our model is not, as you say, to sit here and wait till something falls over and then perhaps we can step in and take all the equity out of it as well. We do have first mortgage rights. We do have a tripartite agreement with the builder and the developer to protect our investors' interests. But the best person to work out a project is the developer in conjunction with the financier in that situation, rather than trying to start again.
Yeah, fabulous. So I mean, there are a few people that are on the call today and on the episode. So really, if you've got any projects that you just like to run by the projects team or Daniel, you've got some contact details there, projects@crowdproperty.com.au. And if you so feel inclined and you're missing scanning in your QR codes when you go to the shopping center, you can point your phone at your computer screen now. Probably a little bit hard if you're watching from your mobile. But yeah, I mean, I think that was really, again, I really like what it is that you guys are doing. We've got our projects that are getting funded by Crowd Property, and it is a co-living project. The experience has been very, very good. It has been very pleasant working with the team. And like I said, it really feels like if there's anything, if you've got concerns or whatever that might be, the fact is that you've always been there to really talk things through. And it's always around finding solutions. It's not about finding excuses to, like I said, to be a shark and come in and take over a project. It's always around how can we make this happen. So I do highly recommend, if you've got a project and you're coming out of sort of residential finance and diving into the commercial lending space and you're not quite sure who to speak to, just reach out to Daniel or David. They've got their details there, and just, I guess, see where it goes.
Yeah, great. Well, thank you, Cheryl. It's not very often you hear those kind words about financiers. So maybe that proves the model is bearing out. So as I said, we're looking forward to funding much more projects. We've got a lot of investors behind the platform now who are getting excited about better returns over high quality projects. So also on the other side of it, if you're not quite ready, but you want to get involved with funding some projects, if you jump on crowdproperty.com.au, you can go and invest in the projects and scratch your property itch and feel like you might be part of the deal. So
Before we wrap up, what is sort of the sweet spot for Crowd Property in terms of the deal size?
Yeah, so we can fund anywhere between your $250,000 on the lower end up to $5 million plus deal sizes. So happy to like what we don't look at is $100 million deals. I think those deals are very well funded by people other than us. But if you've got a project that you're thinking about funding, we're happy to have that conversation. So there's no deal too small. There are deals too too big, obviously, but happy to look at deals as they come up and assist where we can.
So the small scale development finance sort of specialists, I'd probably say, if you're in that small, in that scale of, and renovations as well. Would you look at renovations?
Yeah, renovations, structural renos, cosmetic renos. Again, we assess the deals on its own merit, and provided the deal stacks up and there's, in the developer or the renovator sees a good project, then we're very happy to back them.
Okay, excellent. Thank you.
Good opportunities out there.
Yeah,
thanks, gentlemen.
Your deal falls just outside of that threshold, just get in touch anyway. We've got investors behind us who are interested in the bigger deals as well, so we can generally help out there too.
Yeah, wonderful. Thanks, Daniel. Thanks, David. Appreciate that. And everyone that has joined us and asked questions, really appreciate your input. And make sure, if you really enjoyed that session and you'd like to tune into more business of property sessions, subscribe to our YouTube channel. It is under the Business of Property, or you can search Cheryl Leong. Make sure you visit, and you can find all our past Business of Property videos if you found value in today. Make sure you hit the like button. So till next week, take care, goodbye, stay safe and stay dry, and we'll see you again next time. Bye-bye.